out of the Star Trader course. Day 4. If you have any questions, please feel free to ask anything you want to discuss. I think it's a very important lesson. Actually, every lesson we had till now was very important, I would say, but definitely important to know the basics and advanced risk management. So we're going to discuss that today. We're going to give some live examples as usual. Go to the market, take a look, discuss that too. And let's see what we're going to cover today. So we're going to cover the basic risk-reward ratio. We're going to talk about that. Entry and exit point, where to move in, where to move out. We're going to discuss how to use moving averages, Fibonacci, and give some examples regarding Fibonacci and moving averages. So that's the basic stuff we're going to cover today. And the first thing, of course, is managing a position, meaning risk-reward ratio. And of course, what does it actually mean to accept a risk? So, let's start. First of all, when we're talking about managing a position, first we need to decide exactly where should be our entry point, stop loss point, target, and so on. So it has to do with, every trade is of course different. Every stock is created differently. Therefore, some of them will be very volatile, some less. And we have to decide everything before we move into a trade. And that's why it's a bit tricky, because it does not always look the same. However, we need to make the decision before we move into the trade, because the thing is, once you're already in a trade, things tend to look a little bit different. And what do I mean by saying that it tends to look a little bit different? Once you're already in and your money is riding and you're very much concerned of losing, you in fact tend to have even larger stop loss than you originally would have thought that you're going to have. Meaning, if your original stop loss looked like, well, if it's going to come down by 30 cents, let's say, I'll be out. Then if you didn't come to this calculation before you moved into the trade, once you moved in the trade, the 30 cents tend to be like 50 cents. Meaning you don't really want to lose money. And your target, that usually becomes smaller. So if your initial target was, let's say, 50 cents, then somewhere near 30 cents you are going to start to being very concerned. Therefore, you should decide what is your stop loss and your target before you move into a trade. And of course, that should be acceptable. We will discuss what is acceptable risk reward. Now, when you see me trade, you must have seen me many times start counting the cents before my target. For example, if I have a 30-cent target, and you may hear me, oh, I need another 5 cents, I need another 3 cents, I need another 2 cents. Sometimes, many times in fact, it happens that I just don't reach my target. And trade turns over. It happened to me today, by the way. You know what? I'm actually taking a look right now to try and remember what was it. Was it SKX? I think it was SKX when we shorted that and didn't really get to my target. It was like 5 cents away from my target. But you do see me insisting, really, very strongly on the target. I am trying to reach my target and stand to my rules. I had my target. I am trying to get to that target. I am, in fact, really trying not to change the rules after I move into the trade. Sometimes it works fine, sometimes it does not. Sometimes I make more than I anticipated, sometimes I lose money. But I am trying to stand to my target or to my stop loss. And of course, we mentioned that previously. Having discipline is one of the most important things. So once you establish your acceptable risk reward, then comes the discipline, which is maybe the more tricky part of the business. So first we need to define our stop loss and our target. Usually we should have 2 exit points, meaning your target should be constructed by the first target and the second target. So what I call in our trading room the partial point, where I take my partial, that is in fact the first part where I should put in some money in my pocket, come to the understanding that I can't really lose money anymore, and that's the point where in fact my first target is. So let's talk about risk-reward ratio, and of course, first of all, we need to understand the ratio is between expected loss and expected gain. So we are trying to get to the point where I'm trying to get to the point, and by the way, what I'm just about to teach you may change between different traders. So some traders may have a different idea about risk reward. You shouldn't really have only mine. For example, a good risk reward ratio, in my opinion, is a 1-to-1. Now, do you know Michael from our trading room? He comes in trading stocks every once in a while. He's a forex trader too. He does the morning session, and well, if you ask Michael what his opinion about risk reward, you're gonna get a different answer. Michael specializes actually in trading stocks with a very small stop loss and quite a far away target. That's his specialty. So he's looking for stocks that in fact are standing to this potential. Let's go to the whiteboard for a second. I want to explain to you how it looks like. So in fact, if you take a trade that maybe I would take, then you would see stock moving like that. I'll go to the breakout. I will expect it to get to my target. That would be my entry point. I would expect it to reach maybe my first target, and then maybe my stop loss would lie somewhere around here. So that's approximately 1-to-1. Maybe my stop loss in this case is a little bit better than 1-to-1, actually less loss, more gain. But if you see Michael trading, you will actually find that he is looking for stocks that may look like that and then break out. So his stop loss, his idea of a stop loss would be move in right over here, have a stop loss somewhere around here, and get to a target somewhere around here. So he may have a 10-to-1 ratio. Okay, seriously, he does that. So if he has 10-to-1 ratio and he wins 20% of his trades, what do you think about it? Is it good or bad? What is your opinion about that? Would you like to trade that way? Does it sound good to you? I mean, is it something that you would like to test yourself? I'm not going to say it's good or it's bad. In my opinion, I would like to know what you think. Really, I do have an opinion about that. I wouldn't say it's bad because Michael can trade that way and he can gain that way, and he does that very good. James, why is it not good for you? I wonder. There is an answer. By the way, I will tell you why it's not good for me, but I'm not going to say why it's not good for other people, because it is very personal. Some people may like it, some people may not. It is, seriously, very personal. And I wonder, again, why maybe it's not good for you. Maybe it's good for other people. I see some people here who like it, in fact. You like it, Bruno, because it means that you have very low hit rate. You don't like it, sorry. Very low hit rate. And that's cause... I agree. I mean, that's my issue, by the way. Let's see what James thinks about it, because it can get stopped out sooner than expected. Well, that's the issue. He does not get to the point where he gets, let's say my standard success rate is 68%. Okay, that's my average success rate. Okay, I don't know exactly what Michael's is. It's certainly lower than 50. So let's just say his risk-reward ratio is 1-to-10, and again, I don't know the exact number. And let's say he's winning 20% of his trades. So the problem with that is not the fact that he can get stopped out. Of course he can get stopped out. It's quite clear, because you take a trade here, which your chance to get your target are good, but then even a small pullback here gets you to the stop point, and then it could continue higher and so on. So obviously you're going to get more than 50% losers. But if your risk reward ratio is 10 to 1, then fine, you make money. Now, it is right for people who hate to lose, very much hate to lose. By the way, I'm one of them, but not that much, okay? So, if you are at the point where you say, I'm never going to lose more than, I don't know, $50 per trade, or something like that, then this may be the right solution for you. But the issue, for me, by the way, and I would in fact say for most of the traders I know, the issue is that it messes with your head, screws your head, as Bruno mentioned. Because if you can't really get to 60 or 70% success rate, there's a problem here, mental problem. Because us people, human beings, we like to be successful. And if we are most of the time like 80%, I just gave you a number, I don't know if it's 80%. 80% is not successful, but he has a 10 to 1 risk reward. Yeah, yes, he can make money. So he does make money in trading. He only has 20% success rate. Is it good? Yes, for him. Is it good for me? No. Is it good for you? I don't know. So I'm coming back to my presentation. Do you really need 1-to-1 risk-reward ratio? Not necessarily. You need to find your own system. Your own system may be a little bit different. You may have a different risk-reward ratio. If you're trading like I do, yes, you need 1-to-1. But I'm not here to teach you that you're supposed to be trading like I do. I'm here to teach you that you need to come out to your system. We mentioned that in the first lesson that we had. First lesson, I mentioned you need to develop your own system. Once you develop your own system, you know what you're doing. And so 1-to-1, maybe yours, maybe not. My second target is usually not less than 1-to-2, meaning, okay, so I would sell 3/4, like if I had 400 shares, I would sell 300 at my first target. I'll keep another 100 shares. I'll try to double what I did in the 300. Sometimes it works, sometimes it does not. By the way, again, let's go to just, statistics, basic statistics, monkey statistics, okay? We're not a human being right now, we're a monkey. Sometimes monkey, by the way, have have a better success rate than a trader. Because I mean, I want to say that they don't involve their feelings, so you know what I mean. So the fact is, every monkey could have 50%, right? So if you pick up a stock and your risk reward is 1-to-1, you in fact have 50%. But if you pick a target which is 1-to-1 plus you go with the trend, you have more than 50%. If you go with the trend with a stock that is already up 2% this day and it's also trending, you probably have more than 55%, maybe 60 now. If you add to that the fact that the market is moving up, our first lesson, I remind you, S&P 500, you add to that the market is moving up, well, maybe you're right now at 62% or 65%, and you add moving averages and Fibonacci and whatever, we're going to discuss that today, maybe you come to 70%. Very hard. But still, you can be better and better and better than 50% as long as your risk-reward ratio is 1-to-1. If you try to look for a first target which is 1-to-1.5 or 1-to-2 and you say that's what I want, obviously your risk-reward ratio is going to be lower unless you have a system that supports that. So if you would say, I only trade one trade a day, but I have to find my perfect trade for the day. And if I don't find my perfect trade for the day, which is 1, 2, 3, 4, 5, and you have certain amount of rules that you don't cross. So if you get that rules, and you're playing according to your rules, and you only have this 1 or maybe 2 trades a day, and you're looking for very clear-cut rules, then yes, maybe you could have a system that works on 1 to 1.5 and get more than 50%. But the basic thing is, as long as you have 1-to-1 risk-reward ratio, every monkey can make 50%, and now we start adding market direction, this, that, volume, again, and so on. And obviously, you can make more than 1-to-1. You can make more than 50% chance as long as it's 1-to-1. Now you need to see that it has a chance to get to 1-to-2. You don't necessarily get that, of course, but you need to see that yes, there is a chance. Taking a look at the chart, taking a look at the support resistance, taking a look at what the market's doing, taking a look at the market direction, the trend of the chart, and so on and so on, then yes, you need to plan that. You need to plan the 1-1, you need to plan the 1 and 2. So it is something that you really need to do before you move into the trade. And if the risk-reward ratio doesn't look like it's going to support that, then probably you shouldn't move. Do I always reject a trade because the risk-reward ratio doesn't look like it's gonna cut it? Not always. I do bend the rules sometimes. For example, if I don't see the chart looking great to 1-and-1 first target, but the market right now looks absolutely amazing, it's just breaking down, and I'm taking a look at the chart and I'm saying, oh my god, this is going to break down with the market, and I have such a good support of the market, and so on, then I may decide to take the trade even if it does not have 1-to-1. Okay? You need to understand that you don't always go exactly according to the rule. There's the art of trading. We mentioned the art of trading in our previous lessons. So the artistic part, in fact, kicks in, and you need to really decide, are you going to take the trade or are you not going to take the trade? And that's always very important. So you still need to look for it, and sometimes, and maybe even many times, reject a trade. And that is actually very important, quite critical to have that. Question is, how do you do that? When you take a look at a trade, when you take a look at something that may be moving, a stock that you think is going to go over the highs, or do this or do that, or get you to your first target. I'm trying to, in fact, to find something that we traded today. Hold on a second. Let me see if I can. Can't remember the numbers. Where did we take Kara? Here's the screen share. Do you remember where we took that today? Was it here? No, couldn't be. Actually, I know the number. Hold on. It is in my... $20. Somewhere in... Yeah, here it was. Right here. At 20. Yeah, thank you. I see you've written it. You know, I'm looking at my trade manager over here, and then I found buy Kara 20, quantity 2000. There it is. So okay, so we took it at 20. Let's try and figure out what really happened here. What was our risk reward? How did I manage that, and so on. By the way, when I take a look at a trade like that, sometimes I have the time to start figuring out my risk reward, sometimes I don't. But I don't really do that based on counting the cents. I'm really taking a look at the picture. I'm taking a look at the chart. I'm taking a look at the volatility today, the way it behaved. I'm taking a look at what happened yesterday. Let's try and get a little bit more data out of yesterday. First of all, you can definitely see that $20 was a resistance point yesterday. As you can see, it bounced right over here at $20, so that's a whole number issue. You always find sellers at whole numbers. Then, as you can see here, $20 played yesterday a very important part in Kara. Now, if we move into today's trading, we took that over. By the way, it wasn't my pick. It was picked by some of you guys in the trading room. I just followed one of the picks that was posted in the room, which worked out amazingly good. So Kara was here, was a long, over $20. Where would you say the stop should be? I'll go down so you can see right here on the right side. You can see first of all, when you plan a stop, obviously you don't know the result yet. So forget about the result. You don't know the result. The result was great, okay? Let's try and figure out where my stop should be. So that's $20. I move on in at 20.01, okay? Now I'm starting to move down. Take a look at the numbers on the right side. Try and figure out where do you think your stop would be. Okay, so I'll move all the way down to 90, 50, few cents under, which I definitely don't think you guys are going to tell me it's going to be much more than that worst case scenario. And I'm not saying that's the right number, but again, let me just move down and try and write down where do you think my stop should be. Frank, you wrote 1950. I mean, you never write 0.50. Anyway, it's always going to be, it's too low by the way, 50, but if you mean 50, it's always going to be 1949, okay? Never 50. That's a semi-whole number. You would expect buyers to come in at semi-whole numbers, so never ever 50. Always a cent under 50, okay? Even I usually when I think it's maybe like 60, I would also use a cent under even that, but 50 definitely. 0.50, that's a semi-whole number. Lots of buyers are coming in at these numbers, so never 50. And never whole numbers, always cent under, okay? Yeah, you got my point. Okay, so let's see. So Reggie say 1975, and Scandal says 66, 75, 68, 66, 77. So you all guys are the same area. Let me see. So that's anywhere between 75 over here and 60 something, which is over here. Okay. So we can see there was a resistance over there, right? Right at 74 over here. That was a resistance point. As you can see, stock moved higher, bounced, came back up, finally moved over the high. So 75 approximately is a resistance point. It moved up a bit, pulled back, was supported here. The low of this candle is 71, could that be? Yes, that's 71, so that's another support here. And so you're anywhere between 75 to 66. Okay, when I take a look at this chart, and again, there's no definite right and wrong answer, okay? I'll just tell you what comes up to my mind. When I take a look at this chart, I would try to imagine the following. Okay, so I took the trade, it moved a cent or 2 cents or 5 cents over 20. So now I'm forgetting about what I'm seeing here. I just, of course, when I'm planning my trade, I don't even know it's going to happen. So I'm just taking a look at the chart, trying to imagine what will happen if it would in fact move higher. Now, something terrible happened. I'm imagining this right now, okay? I'm imagining it. Something terrible happened, and what really happened is that instead of moving higher, it started in fact moving lower. Can I actually paint that? There should be some painting tools here, right? I never use them for some reason. Okay, let me just use this line. Okay, so it just moved higher a little bit, but then it starts moving lower. So and there's a big difference between somewhere along this line I would like to be out, okay? Somewhere along this line. So imagine that. Now there's a big difference between a quick one candle move down, which usually is what we call a fat finger. Somebody's selling a lot of quantity. You don't really want to move out until it slows down. You want to have a stop loss under the quick red candle. That's a different way to manage a risk, okay? That's not a risk management, that's a loss management, which is a different issue altogether. So I'm not talking about that. I'm talking about a gradual move down. And of course, it's not just one candle. It's maybe one, maybe two, maybe three. So it's moving slowly down in a few minutes. Okay. So we're seeing a failure. It moved to a new high. Now it starts failing and it's moving down. the point I want to make, and again, that's what comes to my mind, okay, is I'm trying to find where, let me right now draw this line. I'm trying to find where is the point in which I would like to move out. In my opinion, if the stock price would move to this area here, I'm not checking the number now, I don't know what the number right now, okay? In my opinion, if the stock moves down to here, after it moved up a few cents, it could actually move a little bit more than that, because my target should be at least 20 cents in this case, or something like that. So if it moves down to this point, I would definitely tell you that I anticipate a continuation to the downside. Okay, now you remember we learned yesterday you need to anticipate what other people anticipate, meaning you need to anticipate what they will anticipate in the future. In my opinion, if the price would have gradually moved down, again, not one red candle, gradually moved down to this point, at that point it looks like I have 80% chance of the stock not coming back to the highs, meaning continuing moving low. Maybe another pullback higher and then come down. But I would say if it fails, move down to this point, 80% chance it's going to continue moving lower. Therefore, at the 80% point, I want to be out. At the 80% point, I want to be out. Now, if I will draw this line, let me find out what the price is. Actually, it's hard to say here, but let's take a look at this little candle's low over here. That is 1980. I want to be out at 1978, 1970, actually 1977. You've got it right, Jonathan. I mean, mine. One was very close too, so is Regis. Okay, it's not necessarily right, okay, guys? It's not necessarily right, but you got exactly my kind of stop, and my kind of stop is based on my anticipation. Do you think I'm calculating the number? Absolutely not. I'm just taking a look at the chart and I'm saying to myself, okay, that should be my stop loss. Can it reach my... Now, second question, of course, is I take a look at this at this move over here. Okay, I take a look at this at this. In fact, it's like almost 20 cents, a little bit less than 20 cents. Maybe it is 20 cents. Sorry, 25 cents. Right? Yeah, 25 cents, because I never can buy at 20. I'm probably going to buy 1 or 2 cents or 3 cents higher. So that's 25 cents. And I'm asking myself, can this stock move the same distance higher? Meaning move up 25 cents. Can it do that? That's approximately the same distance, right? Can it actually do that? In fact, I should put it a little bit higher, because my entry point is, let me paint another one, not exactly 20, it should be somewhere around here, right? 1 cent, 2 cents higher, so in fact that is somewhere around here. So I'm taking a look at this chart formation, a little bit lower, maybe here. That should be right, okay? That should be right. So I'm taking a look at the way the stock behaved, and I'm trying to figure out whether a breakout here over 20 could take me to this area. First of all, I'm taking a look at yesterday. As we've seen, we have this huge, very beautiful $20 resistance over here. By the way, it's so amazing, whole numbers. Just take a look at the high of this candle. Exactly $20. You see that on the left? Exactly $20. And if you continue, you've seen that several times. So again, whole number finally moved down, came back up today. That's a resistance point. So we don't have much resistance. So I don't have to worry about what happened yesterday, for example, in that case. So what really helps me to come to a decision that it can do that? What do you think? What I should be watching? What makes me believe that there's a good chance that this in fact is going to happen? Buyers and sellers, that's one of the things. Market, sure, that's one of the things. Yeah, it's all true. It's all true, by the way. These are all important things that we are in fact watching in order to come to this decision. Buyer seller history. Yeah, I'm watching the history, and the history in that case is today, mostly today. So I'm taking a look at really what happened. Look at this first candle here. It's quite a big candle, okay? And then it came up very nicely. For example, when it broke over the highs over here, this point over here, it moved from 73 or so to 20. That's a whole number. So that was in fact 25 cents, okay? That previous breakout over here. And as you can see from this day's in fact movement, it is very volatile. It's quite a runner, and the volume's high, and the market was kind of supportive at that time, moved higher. And then if I take a look at everything together, I think Kara can in fact move over the highs at least that distance. So it looks logical. I probably have a 1-to-1 good ratio. Then I would definitely say, fine, I have a trade. Now, of course, you need to take a look at the volume, you need to take a look at spreads, you need to take a look at a lot of other things, but basically, from a quick look, and it doesn't take me long. Usually it takes me like a few seconds to say I'm in or I'm out, maybe even less than that. One quick look at the chart tells me if I want to be in. By the way, if it takes you more than that, that's also fine, because you may not be as experienced as I am, and it certainly took me longer in the past. But again, I don't go to the regular risk-reward ratio which is taught by, let's say, technical analysis books, which may be somewhere around here. That should be, I guess, something that you may learn in other places, and that, by the way, worked out too, because it did reach a 1-to-1 ratio here, even if you had your stop loss over there. But if your stop loss is over here, and that's the right, in my opinion, stop loss, that's the right stop loss, then you only have 25 cents here. If you have 25 cents, what's your chance to get to 25 cents as it moves higher? Better than looking for 35 cents, for example. So if your stop loss is more logically placed, your 1-to-1 risk-reward ratio has a better chance, you have a better chance to achieve your 1-to-1 risk, because your 1-to-1 risk does not lie at 30 or 35 or 40 cents. It lies at 25 cents. And that's not because you twisted the rules, because you really picked the right stop loss. I believe that's the right stop loss. And again, try to imagine what happens if you fail and it moves down. That's the idea of picking the right stop loss. Any questions about that? What is the actual technical pattern of formation that make you take the trade? Just a high and low. Because no, it's not about. It's mostly about today. Today's formation today. When you take a look at the way it behaved today, you can see that it came out with a lot of momentum. So the momentum was on, volume was right, market was supportive. Therefore, when you take a look at what happened today, really, momentum looks great. And that's a technical formation, breakout over the highs, of course, whole number. Take a look at yesterday, reversal. You know you're going to have some trouble with $20, but you certainly have a good chance of breakout and continuation. By the way, if you may remember, I did not manage this trade correctly. I was kind of angry of myself, and I was at that point after some loser. I did finish my day up. How much did I finish up? Okay, I did finish up. I'm out, by the way, $886. So I did okay, but I was at one point over $2,000, so I was in fact losing money once I got to this point. I was afraid that maybe I'm actually going to get to even red, so I lowered my size, which is by the way the right thing to do, in my opinion. Okay, Bruno, I'm glad it sounds interesting to you, but again, it's not necessarily that the way you were taught was wrong, okay? There's so many ways to make money in the market. By the way, more ways to lose money in the market make money in the market. But it doesn't necessarily mean somebody taught you wrong. It is possible that this person who taught you just has this different system than I do. By the way I trade is very much mainstream. Okay, it's very much mainstream. I don't do weird stuff. I don't trade, for example, penny stocks. I don't come to to conclusions which are not really mainstream standard conclusions. I'm doing, my style of trading is something that is being done in Wall Street for hundreds of years, only that they didn't have internet back then. That's it. I'm doing the same thing a lot of traders did before me. So not necessarily you were taught wrong. Okay, so we're still talking about risk-reward ratio, and of course what I'm going to show you right now, that looks on the daily, that's a daily chart, okay? And again, we should consider our risk-reward not only based on the intraday. We just seen a good example for intraday behavior, but we shouldn't consider that only based on the intraday. We should definitely take a look at daily too. So if you take a look at, let's say, shorting this stock right over here, and that should be your risk. Why? Because as you can see, you had some kind of support here, which turned out to be resistance if it moves higher. And then you take a look at your target. Your target could be here. It's also a little bit of support here, which could be of some kind of problem. So worst case scenario, you have 1-to-1. Best case scenario, you have a little bit more than 1-to-1. So again, if you take a look at this specific chart, it looks okay. So again, if you can get 1-to-2 ratio, go for it, but you don't always get that, and usually you shouldn't have it as a standard target. You should have as a standard target 1-to-1. That will lower your stop loss too, as long as you don't bend the rules. As you really think, if you really think that's the point where you should have your stop loss, just don't imagine you have a stop loss elsewhere. By the way, again, I'm returning to what I mentioned at the beginning of this session today, and I mentioned that all of these decisions must be made before you move into a trade, because once you moved into a trade and you're very much afraid you're going to lose, you tend to bend the rules. Okay, don't do that. So that was a good example of maybe more than 1-to-1 risk-reward ratio, and in this case, this is how it behaved. So worked out nicely. Came down to this point, but again, that's of course a good example. And then you have risk-reward ratio if you go high, if you go long. And again, if you take a look at recent support, that's here. But again, that's very technical. In my opinion, it's actually here at 35, especially that you have a whole number over here at 35, and you can see that the recent support was here at 35. So I don't totally agree with what you're seeing here. I actually think it's even lower than that. Okay, so that in fact makes the risk-reward ratio maybe even better. But again, how to tell, how to know. But again, this is what I'm trying to say here, is that's how you need to build your expectation for a stop loss and for a target. Either it's on the daily chart if you swing trade a stock, or it's on the intraday chart if you take a look at 5-minute candles. That's very important. I wonder which one you like better. I wonder which one you like. Let me start a poll actually. Which one do you like better? Chart 1 or chart 2? Risk reward wise. Click the answer please. Just 2 of you guys did. 3 of you guys did. Come on, I need to wake you up. I'm the one who's, you know, giving this class at 9:11 p.m. right now. I don't know where you guys are all over the world, but who's later? Whose time is later? I mean, anybody from Australia here or something? Let me see. Who am I competing with? Or you're all in the States afternoon or something? 2011, where are you based in, Frank? I win, by the way. 2011, I'm 21. 21, Daniel, at my time. Dublin, Ireland. Haven't been there for ages. Just remember the beer. Yeah, Stefan, Berlin. I know. Okay. So you guys are mostly no, I don't think I need to wake you up. Some guys, I mean, there's 25, 24 guys here in the room. Actually, 22 without me, so just 17 of you guys clicked answer. Come on. What the other guys are doing here? Falling asleep? Okay, so most of you guys, 66% of you like chart 1. Interesting. I thought you were going to say chart 2. You tricked me. Interesting. Well, let's try and analyze that. Risk reward in chart 1 is like 1-to-1, right? So we're looking at a 50-cent stop loss, 50-cent target. That's the risk reward. Risk reward in chart 2 is very clear. That's 1 point stop loss, of course, but then you have 3 points target, which makes it 1 to 3. So you're supposed to be saying 3. Chart 2, sorry. But you didn't. You said chart 1. Now I wonder why. Okay. I'm not saying it's wrong. I'm not saying it's wrong. I'm not saying it's wrong. It's actually my choice too. It's my choice too. Uptrend. Okay. It's a special class I'm having here today. Interesting. Yeah, you're right, you're right, you're right, you're right, you're right. You're right. I was just expecting most of you to get it wrong. Why? Don't know. Okay. Yes, it is uptrending. I like it better because it consolidates here during an uptrend and then continues the uptrend. Therefore, even though it's a 1-to-1 risk-reward ratio, it's actually better in my opinion than that one, which is downtrending and you have 1-to-3. So I do like that formation better. Of course, risk-reward wise, maybe I should have, changed a little bit the way I formatted the question. I'm sorry for those of you who may have not understood me. Risk reward wise, that's much better. Chart 2. But in terms of taking a look at the chart, I would rather trade this one than that one. Okay? I would rather. But that just has nothing to do with risk rewards. It's to more like with the chart formation. Okay, fine. Understand. Now, very important thing is to move the stop, to know when to move a stop. So in fact, if you are trading something, you should know that even though you took your trade wherever you took your trade, you still need to know that the stop does not stay in the same place. Let's go back to our cover trade today, okay? So just imagine you traded it correctly, which by the way I didn't today, but let's just imagine you traded it correctly. It still was a winner for me, okay, but I did not manage it correctly. But let's say you did, and you bought here at just above 20, and it moved higher, and you reached your first target. And the question is, of course, where should be now your stop loss for the rest of your quantity? So you're looking for your second target, which you may reach or may not reach, okay? And then at that point you should be selling more once it reaches your, let's say, second target. So where would be your stop loss in that case? What do you think? What number? I mean, you sold some here, maybe 300 out of 400 shares. Where would you keep your last 100 shares stop loss? In this specific case, would it still be here at 1970 something? No, right? I mean, probably not. Under 20, 20.05. Frank, we go back to whole numbers. We go back to whole numbers. If your stop loss, Frank, is close to a whole number, let's say 20.05, okay, 20.05, then please pick, James, if your stop loss is close to a whole number, 20.05, please pick 6 cents under, a cent under 20. Because the same way as you expect some sellers to come in at 20, meaning you buy over 20, like here you've seen sellers coming in, stop hitting 20, going down. The same thing happens when a stock is moving down. It is very likely to be supported at 20. Look at this bottom click here. I'll click on that. Where's the low? Actually 20.01. But still, 20 is a good support area. Whole numbers are very good support area. You don't need 98. Obadia. You don't need 98. You can definitely use 99. Okay? But if your stop loss is very close to 20, again, by the way, I agree with 20.05. You know, let me tell you this. I agree with 20.05. If you went all the way to this target, I think, okay, let's forget about the whole number for a second. Let's forget about the whole, no whole number. That's not whole number here. That's, I don't know what's the number here. Okay, forget about whole number. If I take a look at the way the chart is formatted, I would try to imagine, okay, if it moves slower, where should I be out? Where should I be out? I'm not sure it's 20.05, but the fact, I'm trying to figure out, okay, so it came down here. That in, for example, if you take a look at this red candle here, I would definitely say that I wouldn't be surprised if after this a red candle like that, it would continue higher and move to a new high, okay? So that red candle looks okay, hasn't done anything wrong. You know, I'm always trying to say, you will hear me say that in the trading room several times. You will always hear me say, did it do anything wrong? No, forget about the rest, you don't know. Just concentrate on this red candle here. Until now, it trended higher, yes. Pulled back here, fine. Moved up, trended higher, yes. Pulled back here, fine. Could it technically stop the pullback here and continue higher? Yes, it could. So, did it do anything wrong until that point when it touched this area over here? No, it hasn't done anything wrong. But now I want you to start imagining new things. Hold on, I want to clear these lines now. What I want to do now is take this red candle and try to continue it. Okay? Now, try to imagine that. Let's say this is the continuation of the red candle, okay? You don't have that, you don't know what's coming next. You do not know what's coming next, okay? You only have the red candle and some more continuation in another 2, 3, 5 minutes, okay? Some more downside continuation. At what point would you say, now again, it's imagination. It's imagination now. At what point would you say, and I will add now another line somewhere, at what point would you say it has done something wrong? Meaning, it moved down too much. That's no longer an uptrend. A pullback like that I can live with. I would definitely say I can live with, because I could imagine it moving to this point and continuing higher. At what point would you say that if it comes to that point, then, well, too much. Too much. I don't want to stay inside that trade. That's where your stop loss should be, by the way. That's where your stop loss should be. When I say stop loss, of course, I don't mean stop loss, stop. We usually say stop loss. That's the way we talk as traders, but basically it's a stop, okay? You're already winning money, you sold 3 quarters here, you put some money in your pocket, last quarter size couldn't hurt you. If you're going to tell me that your stop loss is going to be at your entry point, I would be very angry. You're not supposed to have your stop loss at your entry point. Nobody said that, but I'm just preparing to one of these answers which may come. You never, who cares about your entry point? Nobody cares. Does the market cares about your entry point? Nobody cares. Now, if you've got 100 shares, manage them correctly. Try and figure out where is the point where if this red candle will continue, you will take a look at the chart and say, oh, this doesn't look good. No, it hasn't behaved. No, it doesn't look good. I would, let's start here. Too much, of course. Here, way too much. Here, pullbacks too much. Here, getting close. Here, a little bit extended. Here, I would take it up to here. I would take it up to here. I would say, okay, if this red candle moved down to that point, it could easily bounce and continue higher. No, it haven't done anything wrong. Now, coming to the point that you can say that, of course, you need to be looking at like a zillion charts like that and, trade for years and have the understanding of how a chart should look like and what's a really okay pullback and what is a too much pullback, and you understand what I'm saying, okay? You understand what I'm saying. The thing is, for me, that would be the stop point, okay? And that would be the stop point in case I don't have the $20 whole number here. But since I do know that stocks are being usually supported at whole numbers, the same as they have resistance at whole number, they're being supported at whole numbers. Like if somebody is going to place an order to buy the stock, he would probably do it at 20. Why? Stupid. They're not supposed to be doing that, but a lot of people do that. Well, if it's too expensive now, it moved up 60 cents. Nah, I don't want to do that. But if it comes down to 20, yeah, I'll have an order to buy 20. This guy didn't go through my classes, right? I mean, he's not doing the right thing. That's a stupid thing to do. By the way, he missed it because it came down to 20.01, you see? He couldn't buy it. Right over here. Stupid. Shouldn't do that. If you want to go long, you should place an order to buy 20.02, 20.03, something like that. If you really want to do something like that. I'm not saying you want to do something like that. But thing is, that would be the point where I would like to move out. That would be the point where I would actually put my stop loss because it has to be a cent under $20. Again, a whole number. That's how I would manage in my case, how I would manage my stop loss in a stock that is moving up that way, and so on and so on. If you get my understanding. And again, ask yourself several times, ask yourself, did it do anything wrong? What about it? I mean, I'm watching the chart. Did it really do anything wrong? Well, yes, no, up to this point, I think not. And then, if you put your stop loss at the wrong place, maybe you put your stop loss right over here, and that really touched your stop loss and it continued moving higher, try to think, why did you move out? Did you move out because you had too much quantity? For example? Did you move out, let's say you had 1,000 shares, and you were left with 400. If you had 200, would you consider a stop loss over here or over here? If you had 400, maybe your stop loss was 0, and that was wrong because you had 400. Okay, you need to be free of really the quantity, free of the fear of losing, have discipline and everything. Everything must come together. You had a psychology class yesterday with Scott. I hope it was good for you. But basically, you need always to think, what did you do right? What did you do wrong? Based on your own quantity, did you have the discipline to move in, out at the right time? So again, move your stop up. Move your stop up. Well, take a look at the chart and try and figure out where is the right place to put your new stop. Okay? Where is the right place to put your new stop? Based on the chart, ask yourself, did it move right? Did it not? Did it do anything wrong? Did it not? Was the only wrong thing that happened there is the fact that you had too much quantity? That's usually is the answer. Maybe with lower quantity you will trade better. Okay? Let's talk about risk management. Okay, so that's a definition of risk management, whatever. You need to assess it, priority, identify it. Excuse me, I don't want to read that. But you do understand what's written here, I guess better than I do. I'll give you a second, and then we'll move to risk management calculation, which is of course also very important. And let's try and figure out how do you calculate your risk. It is usually said, and I agree with that, that your risk shouldn't be higher than per trade, by the way, shouldn't be higher than 1 to 2% of your account balance. So therefore, if you, let's say you have a $10,000 account balance, then 1% should be $100, 2% should be $200. So anywhere between $100 to $200, that's what you should be risking. Now, of course, if you only have $1,000 in your account, excuse me, you are, I don't want to continue the word, something which starts with F, but seriously, you can't. Because you can't manage a trade with a $10 or $20 stop loss. By the way, you can. In the first 1-2 months when you start trading, you can trade a ridiculous number of shares, fine? Ridiculous number of shares. Do that. Because you only practice. But then, if you start growing, try to make money or try to trade correctly, you can't take a risk of less than $100. It's impossible to take a risk of less than $100 per trade. Why? Because you need to trade at least 400 shares per trade. After a few months, if you do not trade 400 shares per trade, you're gone. You're out of the game. Because the only way you can survive, is if you trade 400 shares. By the way, when I say trade 400 shares, I mean with stocks that move normally anywhere between $20 to $60. If it's less, maybe you can add 200, 100, 200. If it's higher than $60, sometimes they are very volatile, and again, take a look at the personality of the stocks that you're trading. If it has a personality which is very volatile, then fine, lower your 400 to 200, okay? If it's over $60, then usually it becomes a little bit more volatile, lower your size. But the average size of your trade, based on a 20 to 30 cents stop loss, which is approximately what we've seen here in Kara, okay? We've just seen that. Anywhere between 20 to 30 cents stop loss, let's say 25, in this case, in Kara, okay, with 400 shares, that would be $100, okay? $100. Now maybe 30 cents, and again that would be the average, then it can become $120. So if you are trading 400 shares and your account size is somewhere near $8,000, you can in fact survive trading. If you try and trade with less than $10,000 that you can lose, it's very, very hard for you to trade. And again, if people start trading, and I think I mentioned that in our first lesson, people start trading with $500, you can open a Colmex account with $250. Who actually does that? Oh my god, but I've seen so many people do that. Like seriously, what do they expect? To open an account with $500? You know what? Even joining our intro program, our funded account intro program is $500, stop loss of $700. What do you expect? That's why we call it, by the way, intro. It's introduction. You only need to learn how to click the button. You're not supposed to get rich or something. You're not supposed to be making money out of this. You start getting serious when you move to the $3,000 program, because then you can lose $4,000. Is it enough? Well, that's marginal. You probably will need to finance this program once more, get over another $4,000. Maybe the second time around will help you. First time, you must be very lucky. But that gives you some chance. Then you move to the $8,000 maximum loss and the $12,000 maximum loss. And that makes much more sense, because again, you can afford losing 1%. You can afford losing 1%. You can trade 400 shares, and you can risk anywhere between $100 to $200 a trade. And if you can't do that normally, seriously, forget about trading. It's not for you. You have a too high risk of losing your money and being thrown out of this game. And sadly, that happens to 90% of the traders, or more than 90% in fact. But that does not happen to 90% of the traders we start with 10,000. That happens maybe to 50% of them, which is still high, okay? But if you start with 10 grand and you can lose, you survive. So anywhere between 1 to 2% should be your stop loss ratio. Let's take a look at an example over here. By the way, we just talked about it, so we gave an example with Carl. But let's you know what? Let's take a look at numbers here, just to understand. If you lose 10% of your money, that means you drop down from 10 grand to 9 grand. Getting it back you will have to in effect gain 11%. Lose 25%, you will have to do 33% to go back to 10,000. Losing 50%, you have to go to 100% to go back. So account management really is very, very important. And that also means that if your account starts dropping down, let's say you no longer have 10,000, maybe you have 8,000, you should consider 1%, which is $80. Okay, that is something that we're going to discuss, but there's some kind of a minimum that you can't always really. Um, Sometimes you just have to trade 400 shares, for example. Then maybe you need to pick stocks that have better risk reward. Maybe you need to pick stocks that are less volatile, that have a 20 cents target, 20 cent support, risk reward, meaning 1-to-1, but not more than 20 cents. That's when your account starts falling down. So you need to manage your risk accordingly. Bruno asks, how much of your portion do you normally take at your first target? It's usually about 2/3. In my case, I trade 4,000 shares. Many times I would just leave 10 to 20%. Okay, so 10 to 20%, that would be something that I would leave. If I would trade 400 shares, I would definitely leave 25%, which means 100 shares. So as the number of shares that I'm buying is growing, I tend to leave less. So I'm enjoying the last 400 shares or 600 or 800 shares that I'm leaving, but I do take out more than 2/3. In my opinion, 2/3 is a little bit marginal. I think you should try and trade 400 shares and take out 300 shares. If you try and trade 300 shares and take out 200, it's kind of risky, because the last 100 shares could put you in red territory or very close to red territory. If you have 400 shares and you move out 300, it is very unlikely that this trade would end out wrong. So let's call it reasonable quantities. I don't trade the reasonable quantities, I trade higher than that. With reasonable quantities, which may be 400 shares, 800 shares, 1,000 shares, something like that, with reasonable quantity, please take out 3/4. Once you move to higher numbers, you could definitely go to more than that. $80,000 account, Edward asks, with value of 4,000, which is the maximum you can lose. Lost revenue 85 to 80. So what's the question? So this is good. I think being able to lose $4,000 is a little bit of a problem, because most traders lose more than that. Okay, until they become successful. So if you take this program specifically, you can do better. I would definitely suggest that if you start making money, you may want to use your profits in order to upgrade to the next level, which is $8,000 instead of $4,000, which gives you a much better way to make money. By the way, I don't care about the split of 85 to 15. I don't care about it. If you take out the money, that's of course becomes important, because you took out 100%. Doesn't matter if the company had 15, you got 85. But if you leave the money in, then you build your account, and then the 15 doesn't go anywhere. It stays in the account. Nobody takes out the 15 unless you do. So the thing is, you can build your account higher by making some kind of profit, and hopefully you can do that. But again, it's a bit tough with 400 maximum. So out of the Star Trader course today,